The title of this workshop was Survive. And you can go off and do a lot of great things with your business. We're talking about international expansion, getting a business that was booming, getting back into booming. You could be off doing unique marketing things. We have a couple people in a startup mode. Do great things with marketing, great things with making your factory run better, great things with coming up with a new chocolate. What happens, though, to a lot of businesses, especially in tough times, is they get so worried about two things: the grandiose, about where you're going, and they get worried about those things they do every day, that they forget that they really got to worry about first, you got to survive. And if you go look around, and I'm sure all of you, and I won't ask you to raise your hands for this, but you talk to small business owners in the county right now, and this probably applies across the country, but certainly in this county, you ask them how they're doing, you don't get a really good story. The ones that are doing well aren't doing as well as they did 4 or 5 years ago, and a lot of them are scrimping to get by. I had lunch with a guy about 6 months ago, small business owner, a friend of mine, and I'm chatting. I said, "How's business going?" And he said, "Yeah, you're not too good." I said, "Man, that's what I'm hearing from everybody. Most small business owners are telling me they're living off their savings. Maybe not entirely, but to some extent they're living off their savings." He sits back and he says, "Not me. I'm not one of them." I said, "Oh, you're doing well enough then." He said, "No, my savings ran out 3 months ago. I'm cutting everything I'm probably going to have to get out of my house." Now that's I sort of laughed with him because he's a friend of mine. He makes jokes. But the reality of it is you got to survive. That's the number one thing you got to worry about. You got to make payroll. You got to pay your mortgage. You got to take care of those medical things necessary for yourself and your kids before anything else happens. And often we forget about it. What we're going to do today under that theme is we're going to talk about just understanding your business finances. It's another thing. Most small business owners, other than a guy who's out of the financial world, they're not in business to worry about their books or think about the accounting elements. They're in business to make chocolate. They're in business to create booms, to protect the environment, not necessarily to be looking at numbers. We're going to talk about a cash flow forecast. We're going to talk about a break-even position for your business. We're going to talk about being a more effective operation so that you can not only survive, but position yourself when things begin to turn, or even before they begin to turn, you're able to capitalize on it. And then Larry's going to talk at the end about how you preserve the assets you have, how you don't get in some trouble where all of a sudden things you own, you start losing control of. So if you think about it, if you want to make good business decisions, and this gets really amplified in difficult times, when life is good, you can make all kinds of decisions. They can be bad ones, and they're masked by a good economy. I worked in telecommunications. I mentioned I had a company out down in Melbourne. We were in the telecom market. 98, 99, 2000, the whole dot-com bubble. Everybody was buying cell phones, and cable was exploding, and business was going like crazy. And companies, if you weren't growing 25% in my industry, you were doing something wrong. And I watched companies make terrible decisions and still grow rapidly. All of a sudden, you get in a time like today, that's not going to happen. You've got to be making good decisions. To make them, you really need to understand the financial ramifications of what you're doing. To understand that, you need to know the financial makeup of your company. Do you understand what's on your balance sheet? Do you look at it and actually go through it and understand all the line items on it? Again, maybe this group does, but if I were to poll all the small business owners, most of them can't tell me what's on their balance sheet. Their accountant tries to give them some idea of what it is. Do you know your income statement? Or are you one of those guys? My very first client when I went into consulting, I said, "Do you have a copy of your income statement? Let's go through it." He says, "I don't even look at that stuff." "You don't look at it?" He says, "No. At the end of the month, my accountant tells me how much money I can take out of the business." He didn't. Now, he had a pretty good business. He did not make decisions, though, based on what the financial outcome would be. Do you understand your cash flow? Do you understand things about working capital and your cash cycle, how you're tying money up into the business? Do you forecast what's going on with your business? How many people know or have a good idea of what they're going to be doing in 6 months? And again, don't be shy. Other than the fact that we're on film for those 2 million YouTube viewers, no one's going to see it. But again, if you're not forecasting it, how are you making a good decision today for something that may or may not happen later? And are your expenses what they ought to be to run your business? Managing the activities of a business in consideration for the financial condition and anticipated outcomes, that's what financial management is. A lot of folks think financial management, we're into accounting. Two totally different things. If you're an accountant, that's looking at where you are today or how you've performed over a period of time. And no accountants in here, so I don't think so, right? You're an accountant? No? No accountants in here. They're bean counters. They give you a situation, a status of today or a period of time. Financial management is using that information so you can understand what you need to do, what the expected outcome is. You're not in business just to do things. You're in business to make money. So you need to be able to look at the numbers, manage to them, and understand that. Everything from the capital requirements, your assets, the financial risk when you make decisions, what are the upside and the downside of what can happen. You really want to understand the value of your business. If you just think about a couple things, if you're going to put inventory in, what's that do to your business? Does that generate more sales? Can you afford to do it? Is it going to eat up all your cash? What if you make the inventory? What if you make a whole bunch of chocolate and nobody buys it this month, and all of a sudden at the end of the month you got a bill and you can't pay it because it's all tied up in chocolate? Or you go buy a bunch of logs. I don't know, not you do that, but you go buy a bunch of logs. What's that really do to your business, and what's the financial implication of it? A lot of people say, if I have inventory, if I have a whole bunch of golf balls sitting around, okay, I'm putting money into that. Well, some people don't have clubs, so I'm going to go out and buy clubs so that they have good clubs to use. You're making a financial decision on an inventory, on potentially a capital thing, and what are the ramifications of that? Do you really understand it? If you raise or lower prices, man, it's a tough world. So if I lower prices, my business will be better, right? Maybe. A lot of people, go into a clothing store today. Does anybody here buy anything that's not on sale anymore? I don't think I have bought anything not on sale for at least 5 years. In fact, if it's not like double, triple on sale, I'm getting 10% today on top of the 20% this week, on top of the 30% they're offering all the time. I don't even think about buying things. So what's going to happen when you make those decisions financially? Maybe you need to do it because you got to sell, but what's going to be the financial ramification downstairs? You need to think about these kinds of things as you're going through the management of your business. So we're going to fairly quickly step through the different financial tools that are at your disposal, and then we'll talk about how you can use some of those things. The balance sheet illustrates the current financial position or the health of your company at a given point in time. So typically, folks will look at their balance sheet at the end of the year. They ought to be looking at it at least once a month, depending on the state of your business, maybe more so, or at least looking at portions of that balance sheet all the time. And it's real simple. And your accountant's probably going to give you something a lot more complicated than this, but you can condense it down and get an understanding from them. You've got assets on it. Assets include the current assets. That's cash, receivables, inventory, short-term notes, those things that either are or can be quickly converted, theoretically, to cash. Then you've got fixed assets. Those are the things that are longer term in nature. They may be a building that you're building downtown. It may be equipment, whatever you have to buy to run a golf course. If you're into engineering kinds of things, you've got probably some sophisticated hardware and software you're using for something or another. And then there's some other intangibles that may be on your balance sheet. And then it's the liabilities. Real simply stated, that's what you owe somebody. The current liabilities are payables. I bought sugar so I can make chocolate. You're going to have to pay somebody money for that. It could be notes to a bank, to whoever you're borrowing money from. It could be accrued expenses. She's worked for me for the last week. I haven't paid her yet. I have a liability to pay her at some point in the time. And then there's the long-term ones, the equipment loans, other kinds of loans, mortgages on buildings, those things that have a longer lifetime that you're not going to pay off the whole thing inside of a year becomes your long-term. Equity is what's left afterwards. If things are going well, you subtract your liabilities from your assets, you're going to have a positive equity. Hopefully that's a bigger number than a smaller number, and that's why they call it a balance sheet. By definition, the assets have to equal the liabilities plus the equity. It's a real simple thing, but as we step through this, you'll understand. You want to know what is on your balance sheet and what it means to you. Now, you're going to see a company I've called Survive that's going to show up during this presentation a number of times. And believe it or not, I had an accountant in the last session we did who did test it, and the numbers do, in fact, correlate. So I guess my accounting 101 must have worked for me. So here's a company, and they've got $8,000 cash on hand. People owe them about $200,000. for the product they sell. They have about $2.8 million of inventory sitting around. Go through the rest of it, they got about $500,000 tied up in a building, $250,000 in factory equipment. They owe some people some money in trade payables. They've got a credit line, outstanding, not an open credit line. This is what they owe on it, of about $1.5 million. Take a look at that balance sheet. Is there anything on that thing that sticks out, or excuse me, on the balance sheet, anything that sticks out to you?
The amount of cash compared to the inventory.
Yeah, they don't have much cash, do they? If they've got that much inventory, why so little? It must be a reasonably good-sized company. Why so little cash? Would that worry you? You have a situation like that on any of your balance sheets? You really haven't looked at it closely?
It'd be worse if they owed a lot of money on it. If they got it paid for, that's another thing.
If they got the inventory paid for?
Yeah.
Well, maybe. That's, to me, anybody else want to offer?
An asset, I don't care, you know.
Is it an asset?
Paid materials, you bet they.
If I have a company with that much inventory, one of the things that sticks out to me in here is that's a lot of inventory, given everything else up here.
You have to think of the time value of money. How long is it going to sell you to sell the inventory?
Yeah, how long is it going to take you to sell it? If I have that much inventory, is it good? This is
$2.8 million worth of orders coming in next month. It's good.
It's good, but if I've got that much inventory, start to think about why I have that inventory. Is there a chance I have that inventory because it's not turning, it's not selling? Or I just got crazy. I'm one of those people who said, if I build it, someone will buy it.
Well, the numbers really don't mean anything until we compare them to what the situation is.
Absolutely, but you need to start looking at them and understanding them. And on your own balance sheet, look for those things that may be a little bit out of line. I got a credit line. That's typically, it's a rolling line. You generally pay a fair amount of money to have those things. I got $1.5 million I'm paying on it. So I don't apparently own the assets. I'm borrowing money to have that much inventory.
Yeah, that's killing you.
So it's probably is. I won't say maybe the guy made a good decision, the guy that owns Survive, but maybe he didn't. But think on your balance sheet and go through the same kind of thing we just did in 2 minutes. Do things make sense? Are they sustainable for the long haul? The income statement. The balance sheet says this is what my health is today. The income statement essentially does the same thing, but it does it over a period of time. It talks about the business activity. Over a period of time, have you or have you not been financially successful? And it has revenues or sales, cost of goods sold, typically a direct cost. Then you come up with a gross margin. Then there's selling and administrative costs and your salary and some other things. There may be some other operating expenses or overhead. And then real quickly, take all of those expenses from the sales and you're going to have the profit of the company. Again, it's fairly simple. And when you get your QuickBooks dump, probably be a lot more categories on it. It'll be a little bit more confusing. But at the end of the day, you got sales, you got expenses, and the subtraction of those is your profitability. And that will tell you, again, in a period of time, how well you're doing. And if you look at your last year, December 31st income statement, and it says you had a lot of profit, that's a good thing. Well, did you look at January, February, March? Or I was dealing with a client today, and they really were they made some changes. They were looking at their income statement on a weekly basis now, because they really needed to understand the financial impact of those decisions. Was it going to help the business or not help the business? And lo and behold, they found some problems, and they're taking some actions to rectify it, not waiting till the year-end income statement, which a lot of folks, frankly, will do because that's when you look at them because you got to pay taxes. So here's the income statement of the Survive company. They make one product. This is a really simple company. They make one product that costs $50 a piece. That's how you end up with about $1 million of revenue. A few things came back. You had some allowances for it. So the materials that go into this are $20,000 a piece. So you end up with a cost of goods sold. In the way I've done this, only the materials went in the cost of goods sold. So I have a gross profit of about 59%. That looks pretty good, but then I've got some other costs to run the business. I got salespeople costing me money. I got administration and management costs, supplies, and I put the factory labor to build this below the line. If you have a factory, or if you're putting labor into a product directly, often that may be up in the cost of sales, but it can go either way. When you look at your income statement, you need to understand where the costs are. Don't presume you're the same model as somebody else. And this is where you got to sit with your accountant and say, explain this to me. And I'll tell any small business owner, whether you like accounting or not, you better understand your own P&L, you better understand your own balance sheet. You don't have to be an accountant. You can ask the questions, but you better understand where the numbers are and what they mean to you. You guys like that income statement? Anybody want that for their business? He must be, if he wants that income statement, then he must be losing money because this company isn't making a whole lot of money.
No, I'm talking about in an overall picture, you have to do that.
You have to look at it. But this company only made $5,600 on $1 million of revenue, and they only got $8,000 in cash.
He's a new manager, that's for sure.
He owns it. It's a self-owner. He owns the business, so he's not going to go hire a new manager. And then you want to look at your cash flow statement. And that really is changes in the balance sheet and the effect of your income on your cash flow. And you've got to look at the operations, what's going on, ongoing basis with the business. You're bringing in revenue, you're sending money out. What kind of investment are you bringing in? If you bring investment in, that's positive cash. If you finance it, if you're making an investment, you're generally giving somebody money to get something, some capability for your business. And financing, you may be bringing money in to do that. But you want to understand the cash flow. And in a tough world where you may be feeling that you're struggling more than you would like to be, or you're in am I going to survive mode, if you're in I'm going to survive mode, then cash becomes an extraordinarily critical thing to worry about all the time. So here's the cash flow statement for the period of time of this income statement. They started off with about $25,000 in cash. They got some profit coming in. They had some receivables, actually an increase in receivables, so that cost them cash. They sold stuff, but they haven't gotten the money in for it. So somebody else, they're financing somebody else's business. Inventory changed. It actually decreased a little bit. Depreciation shows up as positive cash. Anybody understand why that would be? If you're depreciating something, that's an asset that you paid the cash for sometime in the past. So it shows up, and as you depreciate it, it'll show up as an expense on your income statement, but it's not a cash expense. So when you look at the $5,600, you've taken out, for this company, they've taken out $35,000 of expense as they have depreciated an asset, but it's not a cash expense. So they can put it back into the equation to show the cash flow. This particular company went out and spent $75,000 on equipment, and they borrowed $50,000 to get there. So they ended up at that $8,000 we saw in the balance sheet, cash at the end of the year. Anything bother you with that cash flow statement? Guy's taken, I think, a risky cash position. He didn't have a whole lot of cash to start with, and he's got a lot less cash. I hope this is a good investment decision that he's making. So did you guys bring their own financials from their businesses? Just take a minute and look at it relative to briefly what we talked about. If you don't have a cash flow statement, but you brought financials, see if you could take about a minute and create one from it real quickly. See if it tells you something. So think of the business you have then. I'll just ask you some questions and you can mentally go through them. How much cash do you have? How much cash did you have a year ago? Why has it changed? Most of you probably have that in the back of your mind. Man, I had $100,000 of cash in the bank a year ago. I'm down to 20. What are the reasons that could have happened to me? And did I know it was happening?
In our case, the large commercial accounts dried up.
So where'd your cash go?
Sales are down, so.
But you kept spending, money kept going out the door? Had to keep paying bills?
We had to lay off a lot of people too.
So you took some action, but your cash is down, so did you take enough action?
No, you still have overhead.
Maybe, we'll come to that, maybe. How about how many people carry receivables on their books? I mean, some businesses, I don't carry much in the way of receivables. Well, why not carry none the way I do my accounting, but a lot of services business receivables are irrelevant. But if you have a product, so receivables, so are they going up or down?
Right now, they're going up.
They're going up. So sales are going up too then, right? Oh, that's a good thing. I thought you were going to say no. Anybody have receivables going up with sales not going up?
I got a lot of receivables
A lot of receivables.
that I didn't plan.
That's not atypical. Why is that happening? And what's that do to your cash flow?
Well, I did a job for some people and then they didn't pay me. That was a big receivable. I'm lining up for the whole place. I'm lining up for the whole building.
You know, this is about, so what's that do to your cash flow? You don't have to answer the question. I don't want to get too much into everybody's good news or bad news for their business. But if all of a sudden somebody doesn't pay you and your receivables goes up with everything else being constant, that means you don't have cash. So when you get to the end of the month and you got to pay the overhead, maybe you don't have cash to do it. So those are thinking about those kind of things as you go through this and having that cash flow developed all the time. Are receivables going up? I mean, they're going up for everybody. This is about a year out of date, but I was talking with one of the local bankers about a year ago, and we were talking about state of the economy. And he raised that I guess you can go on the FDIC websites some places, and you can find out delinquencies on loans and that. And I guess in a healthy economy, loan delinquencies in an economy like Brevard County are around 1%. About a year ago, they were running 12% in the county. So people they're stretching it out. If they're not paying on a loan to a bank, I guarantee you that decision came after they made a decision not to pay a vendor, not to pay an employee, not the bank's going to get money early because the bank has more clout than most vendors. So if that's happening in the banks, that says a lot of people are slowing down what they're going to do to pay you. What's that do to your cash flow? So think about those kinds of things. Okay, working capital. Current assets versus current liabilities. Forget the building, forget the long-term notes, forget the mortgages. Just look at those things that are current. That means they're either cash or can quickly be converted to cash, theoretically, within a year's time period is what it says. Typically, it's even less than that. So it's cash and equivalent. The receivables, how big are they? What are your terms on your receivables? How long do you give somebody to pay you? Do you give them a discount if they pay early? What's that do to your cash flow? A lot of times you'll see 30 days, 2% net 10. So if you pay me in 10, you can give me 2% less of what you owe me. Otherwise, you have to give it to me in 30 days at the full amount. Is it slow? So are you actually collecting a receivable or have you become a bank? Is somebody using you to finance their business by not paying you? Inventory, do you have enough inventory? Are you losing sales because you don't have enough? Do you have too much inventory and you're not getting extra sales for it? Do you have the right inventory? Did you build the right stuff? Did you have the right chocolates? Do you have the right logs?
It's so easy for me to get a $100,000 inventory. It ain't even funny.
Yeah, exactly. I mean, you make one decision, your cash flow you make a big thing. So one decision on a big thing could cripple a cash flow. It's not like making a bad decision on a small run of some sort of a chocolate. It may not cripple you as much. So I have a company I know out in the western part of the county that has, it can't be that far from here given east to west is not much. It's the western part of the county. That could be like next door. They have a very high inventory level. And they weren't really dissecting it. They weren't doing this kind of analysis. And finally, they got in some financial trouble and they had to go look at everything. And they found out about half their inventory had been there over 2 years. So they started saying, what is it? And it was like, no one's going to buy this stuff. You know, new general manager, why was it ever built? Anybody there that can remember denies that they were involved in the decision. But they have some really bad inventory. So they've got a substantial amount of money tied up in something that is not going to sell. Absolutely not going to sell. Are you turning over fast enough? Do you have inventory? Is your inventory comparable to your competitor? That's one way of knowing whether you have the right inventory or not. If you've got more than all of your competitors and you don't have more sales, chances are you've got too much inventory. So there's a lot of macro information you get in the marketplace, but also get into the details. Do I have the right 10 different truffles or Do I have steel versus aluminum? Do I have the right kind of stuff? And accounts payable. You know, what kind are they? Are there discounts you could take? What are your supplier relationships like? If you have really good supplier relationships, you can call them up and say, I got a cash flow problem right now. Can I hold off for 5 or 10 days? Have you built those kind of relationships so you get into the cash part of it? What are your bank notes? What taxes are due? Don't be late paying your taxes. I do it periodically. I pay a couple $100 fine about once a year because I don't pay attention to that stuff myself. I don't do what I teach. So don't do that because you will. The government is not nearly as forgiving as a vendor may be, actually. So those are the things that go into the working capital equation. And then you want to start, I mentioned a moment ago, compare yourself to other businesses. One way you can do that, and also to compare yourself to yourself, is look at the ratios in your business. And these are comparing one item on your financial statements against another. And there's reasons why you want to do that. You can compare yourself with the industry. Because you not only compete on things like price and the marketing aspects, we think I compete by having a better product than somebody. I compete by having a better brochure. I compete by having better ads on the radio. Log cabins go in certain kind of magazines you probably advertise in. I do that better than other. That's how I compete. But you actually compete on your financials as well. If your competitor has better margins than you, what's that mean to you from a competitive standpoint?
They're gonna buy the cheaper stuff.
I didn't say cheaper. I said maybe he's more expensive, maybe he's less expensive. He's got better margins. What's that mean? It means he has the ability to spend more money than you to do something to you competitively. If you do have to have inventory, he's got the ability to buy more than you. If you have to have cash to support your business with people, he's got the ability to react to it. Does he have higher or lower inventory turns? Does he turn his inventory? When he builds something, does he put it into his customers' hands faster than you do? If he does, he needs less inventory. That means he has more money. That means he can react to changes in the marketplace faster. If you go back about 3 years in time, maybe a little bit more. We actually had somebody in the last conference that worked for IBM at the time. IBM was selling PCs. And they were selling them, they were turning their inventory about 50 times a year. I'm sorry, about 3 times a year. 3 times a year. So if they would build inventory and only turn it, it's a ratio. How often do you turn it? Divide your sales by your inventory level. If you're only turning it 3 times a year, that means you have a lot of inventory to generate a certain level of sales. Dell, at the same time, had a different business model. They were turning their inventory 50 times a year. 50 times a year. Direct competition with IBM. You guys probably know that marketplace. Who won? Who won? Dell won, because they were putting things out there so much, they had less cash tied up in their business, so they could be more price competitive, because they didn't have the cash tied up. They could adapt to consumer needs faster. If you called IBM, they had computers sitting there. I don't have that one, I'll have to build it for you, I guess. Or you could choose out of their stock. If you called Dell, they didn't even have the computer sitting there most of the time. They had the ability to take your order, go out to their vendor base, bring the parts in, assemble the computer, test it, and ship it to you in a week. That's how they turned their inventory so fast. It made them extraordinarily competitive. And if you look at their growth curve, I mean, it was just absolutely enormous. And they were a case study in business as to how to manage inventory. So that's one way of looking at the ratio. That's one ratio where you can compare yourself to a competitor. If your competitor turns his receivables faster than you, if it's taken you 60 to 90 days to collect money that's owed to you, and your competitor is getting the same thing, doing everything else the same, but getting it in 30 days, who's got more cash tied up in their business? Who's going to be more competitive? It's going to be him. They have more cash at their disposal. The other thing, now that's comparing it to your competition. That'll teach you a lot about your business. In fact, often people will say, well, how do I know anything about my marketplace? How do I know the financial? I don't know anything about that. How do I go out and get market information? One of the best ways to do it is to go look at the competition. And if you have one competitor, it's hard to understand the marketplace based on his decisions. If you have 10 competitors and you roll up everything you can know about them to understand them, that's going to tell you everything you need to know about your marketplace. So study your competitors, not only what do they offer, how much do they charge on it, and how do they advertise, but what do their financials look like. The other thing you can do is track your own business. So if you're out there and you're tracking what's important to you, what ratios are important to you, and you start looking at them and look at them over time, and they begin to change. If you're looking at receivable days, how many days on average does it take you to collect money? And you were at 15 5 years ago. And then all of a sudden you're watching it and you think that's important because that's where a lot of your cash is tied up. And all of a sudden you wake up and it's at 18, and it's at 21, and it's at 27, and it's at 40. Finding that out and watching that kind of a trend, if that is an important ratio, is extraordinarily important. You don't want to wake up at the end of the year and say, how come I had a bad year? Oh, my receivables are at 50 days now. They used to be at 15. What happened to me? That's the kind of ratio you may want to look at on a repetitive basis. And again, the ratios may be extraordinarily different for the nature of your business. These are just some sample ones. Current ratios, current assets over current liabilities. So what do you think would be a good number for that one? Current assets over current liabilities. Which would you rather have, 0.5 or 2? 2. The bigger that number is, the more solid you are, certainly in a short-term cash thing. Quick ratio is the more liquid stuff. It's the same kind of thing, though. It's the current things, just happens to be cash, and things that are typically very convertible to cash in a short run, divided by the current liabilities. Things like debt to worth ratio, gross margin, your profit relative to your sales. For most businesses, that's a number worth tracking. Net profit margin, accounts receivable turnover, inventory turns. No accountants in the room, but there's like 1,000 different ways you can calculate some of these things. I always like annualized sales divided by inventory because I can get that data publicly on any public corporation and compare myself. And there's a lot of services out there where you can get that information very easily on non-public corporations. Return on assets. My net profit divided by my total assets. Now, who's got more of a service business in here? You pretty much service business. Does that ratio mean much to you? I think my assets for my tangible property tax, I think is $150. So do I really care about return on assets? It's infinite almost. You know, I get 1 hour of work and I've just, I'm already, killing that. Who's got a lot of assets in their business? You bend metal and stuff. You must have some hard assets. Bill's raising his hand. He's got all that fancy equipment back there. And I've been to his shop. He's got a lot. Yeah, you got a lot of stuff tied up in assets. So his return on assets is going to be important to him. When I ran this manufacturing business, contract manufacturing, really tough to make money. If you were doing well, if you were making more than 4% return on sales, that was good. That was good. Most people weren't doing that well. And this is when life was good. It was.
The turnover, are you talking over at that rate?
Well, return on assets, we actually said that's the thing we want to do. We're not going to, return on sales, as long as we're making money, we're at least equal to the industry. Most people the industry was doing about 10 to 12% return on assets. And we said, if you're not making money and you're at risk, and that's all you're getting on a return on assets, that's a bad business to be in, right? Well, there was like a $50 billion business, as that was the average. We said, we don't want to be the average. So we said, we're going to go after return on assets. We managed our asset base aggressively, and we were running about 35%. And we were quite proud of that, and we were killing our industry. And our corporation would say, oh, geez, you didn't send us a whole lot of money this month. Yeah, we didn't use a whole lot to make it either. Go look at the rest of the industry. And we had a successful business. And by the way, we outgrew our competitors by a factor of about 2 to 1 over about a 5-year period. So we focused in on one of these ratios that we thought was the most important for our business. The results would say we made a good decision there.
Did you have financing in that business?
We used some financing, yes.
What was they manufacturing?
Cell phones, pagers, sophisticated, very high-tech electronic.
Turnover a little fast.
Pardon me?
Fast turnover.
Well, our payment terms, we didn't sell to the commercial market. We sold to the Motorola's, the Nokias, et cetera. So our payment terms were entirely different than they had when they went out to the marketplace to sell them. So think about your business, what's important to it. If you're in a service business, a lot of these may not count. Even profitability doesn't count for my company because my company doesn't really ever make any profit because when it starts making money, it raises my salary, which is going to be true for many service businesses kind of thing. But still, what's important? We had a good discussion about a week ago. Someone said it's not on the list, and we started talking about time elements. How much of your revenue is from certain sources and how much of your expense? Because for me, I make money by being employed by somebody, not by out marketing myself. I don't get paid to show up 40 hours a week. I get paid to do something. So if I'm doing something 40 hours a week, that's great. If I'm doing something and getting paid for it 10 hours a week and spending 30 hours trying to get that engagement, that's not a terribly profitable, I'm not going to be in business very long doing it. So that's sort of a ratio some service people will use. It really gets into the time element, and you can compare yourself to the competition doing that as well. Business I'm in, if you go study it, people will tell you it's about 30% marketing time. I thought, not me. Not me. I want to get down to like 0. And the closer I get to 0 and the more time you get on being paid, the more profitable you become. And guess what happens? You're out there more and your business grows even more. So think about your business and how you ought to direct those kind of things to look like. So if you have, just think right now, maybe you want to volunteer. Since most people didn't bring your financials, you're not going to come up with a ratio. But in your business, what's the thing you want to track and why? 1 or 2.
The thing you want to do what, sir?
What ratio is important to your business? I would think some inventory ratio, turns or something, but with what you just told me?
Well, the people that I deal with come in and they may give me, they want an 8-inch log house or a 10-inch log house or something like this. And we design their house for them, draw the plans, and then we figure all of the building materials right down to the last board. Everything, all the cement, the blocks, the concrete, the steel, the foundation steel, everything goes up. See, our foundation steel goes from the foundation in our house clear up through the top of the wall. Our whole house is bolted down.
So from a financial standpoint, what are the things you're worrying about and how would you compare yourself to the rest of your industry?
All of those different items are costed out. I don't get involved in them any more than to tell them what they need to buy. And the other thing I take is the money from the bank to see that these bills are paid. I make sure there's no liens out on anything. And the other thing, that when we ship our products, we ship in sometimes big trusses and big things like that. And then the several semi-loads of lumber will come in. And I buy all this stuff and I make a profit on all this stuff. So my whole package, like on lumber, you make a very small profit, but it adds up to 1,000 feet.
So you may want to look at return on your assets. It's small profit, what kind of assets you have into it. It may be the time. We're going to talk about the cash cycle in a minute, but who is selling for, your husband is selling for somebody else essentially. So there's probably a 2-step process before he gets paid, I'm going to guess. So that's probably a lengthy process. You probably have I'm going to guess you have a receivables you want to watch. Have we been paid yet? That question probably gets asked a lot in your business. So you'd want to be watching the payable cycle. In your business, you've got to have that stuff ready to go, don't you? And yet it's not needed on a regular basis. It's needed when there's an emergency. If you had a lot of inventory maybe when the oil well busted in the Gulf?
We started in January. So we had 4 months to get everybody trained, and then all of a sudden we were hit with an oil spill.
So your timing's good. So if we're talking about timing, rub elbows with her. But then again, if you didn't have the inventory, did you get the business? So when you think about that, so you need to manage, I'd be looking at my return on my inventory and those kinds of things because your sales are probably not at all even. They're probably up and down and all over the map would be my guess. So think about, but you've got to carry some cost relative to the inventory. So think about your business and what do you want to track over time? What do you want to track over time that'll tell you whether you're getting better or not getting better, and then how do you best compare yourself to the industry out there? And then cash. Why do you care about cash? I'm making a lot of profit. Who cares about cash? Why?
I don't know, I think cash is pretty good.
Why do you care about it? None of us even use cash anymore, do we? I don't know. I went to Publix the other day and I said I had a really profitable month. Is that okay? Will you take it? If I tell you I'll give you 5% of my profit? I was like, no, I want to see cash. You pay the bills with cash. It's extraordinarily important. And in a tough business environment, when you don't have as much cash as you would like, you watch it closer. When a commodity becomes scarcer, it becomes more important. What's happened to the price of corn recently? It's scarcer. Prices have gone up. Oil, maybe not scarcer, but certainly a threat of, I won't get into why oil prices were up, but certainly there is a threat that it's going to get scarce. I don't know about you guys, I follow what's going on in the Middle East all the time, and I'm scared to death that one day we'll wake up and there won't be any oil supply. Well, that's just me, but the guys that actually trade in oil, they worry about that kind of stuff too. And when they get more and more afraid of something becoming scarce, the prices go up. Same thing with cash. It becomes very, very important the scarcer it is, and that's why you need to worry about it more. Forecasting your business, especially your cash flow. Because if you run out of cash, what happens? You're done, right? You're done. You can only beg from Grandma and Uncle Ted for a certain amount of time, and then you're done. So you really need to forecast. And if you walk away with one thing today, be forecasting your cash. Because when you wake up someday and it isn't there and you didn't see it coming, you have no ability to react or make a decision. Your cash flow, whatever cash you're going to have in September, the decisions you made in your business today had far more to do with your September cash than any decision you'll make September 1 on. So it's absolutely vital to forecast. Take the time to do it. You can get company data from yourself. You understand, you know something about repeat customers. You know there are regulars that come to your golf course, so you have some idea of what's going to go on from a cash standpoint. You probably got some chocoholic that you know there's 5 people that are going to buy $5 a day from you, whatever it would be. So you can look at your own data and start to forecast it. You can look at your history. What did I do historically? Will that repeat itself, or what has changed in my business that'll cause that not to repeat? Maybe go up, maybe go down. Go out and look at the industry data. Whatever industry you is, there is so much data you can get. Just click on your industry, search the internet tonight, and you'll get more data than you could ever digest. So filter through that and look at it. Is my industry getting better, or is it getting worse? Is the overall economy getting better, or is it getting worse? Anybody have an answer to that one?
Yeah, it's your lousy banks.
I don't know. Are they lousy? Who knows? Is the economy going to?
What side of the economy you're on?
Well, let's just take the general economy. We don't necessarily.
Businesses have more cash in the fourth quarter of 2010, right? In their coffers, so business seems to be doing okay.
Some businesses have a lot of cash. I don't know many small businesses that are sitting on cash. But look at what's going on in your industry and get that information. And look at some of the global things going on. Because when you do your forecast, it's not necessarily a static number. You want to look a little bit at the upside and the downside of it. So you forecast, I'm going to have $100 this month, $150 next month. Then the following month, I'm going to have to put $200 out the door. And you forecast it out. And that's all dependent on the fact that the overall economy or the Brevard County economy is going to grow 3%. So is it going to grow 3%? I don't know. I could turn on the news tonight and some analysts, I'm going to flip CNBC on, and there's going to be one talking head that says it's going to grow 6% this year and another talking head that's going to say it's crashing. Somewhere in the middle is the truth. But that will have an effect on your forecast. So understand those kind of things and put a little upside and downside on it. And when you look at the downside, if it's an uh-oh, you better take some measures to protect yourself now. And that's why you want to do the forecast. Create a pro forma. Essentially use this as a budget. I have revenue coming in. I have expenses going out. That gives me cash at the bottom line. Set that up as a pro forma. So if you see things happening in your business that says the revenue's not going to come in at the same level or it's going to come in higher, that's going to have an effect on my cash. And if you see expenses going on, if any of you use gas in your business, which is all of us, so what's that do to your cash flow? If your cash flow is going to be 0 in January when you predicted it, and you drive around a lot, or you use gas to, I don't know, maybe you have gas machines in your business. If all you do is use your car, it's going to have an effect on it. So you see a price going up, you got to inject that into the pro forma and see what it does for your business. So lay that out, because again, the decision you make today is a decision that's going to affect you long term. So let's go back to Company Survive. He did a cash flow forecast. He just didn't have a wide enough piece of paper to put all the months on it. So we went out January to April, and then we looked at the end of the year. And his cash flow forecast says in the month of January, for whatever this business does, they're going to have positive cash of almost $46,000. That's a pretty good month. But the following 2 months, $44,000 is going out the door, $14,000 is going out the door. Now, and then, but I'm not going to worry about that, right? Because then I got $20,000 coming in at the end of the year. You know, I'm sitting around $70,000 in December. Pretty good? Am I happy with that cash flow statement? 45, and I subtract out 44, it says I have a net $1,000. Then I go 14,000, so I got a net 13,000 going out the door. How much cash do I have on my balance sheet? Remember? 8,000? What's going to happen to my friend that owns Survive in the month of March? He's out of money. He's either begging from Grandma and Uncle Ted, or he's out of business. He can't pay a single bill. He doesn't have any cash. So what's he got to do? Now, if he finds that out here, what can he do then? Almost nothing. If he finds it out now, what are some of the potential actions he could take?
Spend less.
Spend less. Just cut expenses.
Yeah, get rid of that high overhead.
He's got high overhead. Get rid of some of it. Anything else? Man, this guy's got inventory like crazy. He's building more. Tell the factory we're shutting down for 2 months. Can't afford it. I got to sell the inventory I have. Sell the inventory cheap. Okay, inventory's worth 2.8. Maybe I could sell it all today if I sold it for 2.5. Maybe I could unload 100,000 of it for 50,000. Would that be a good decision for this company? Maybe. He shows a profit loss, but he survives. He survives. If the only way he can get it is to sell it cheap, that's a way to get cash. And again, we're talking Survive. We're talking Survive. Whatever the decision will be, if he makes it here, he's got time for it to take effect. If I decide today, I got to lay people off, I got to cut my admin, how long is that going to take me? Going to give me any severance?
90 days, maybe.
Maybe 90. No, I could make the decision today and I could let you go tomorrow. I'm a nice guy. I'm going to give you 4-week severance. So when do I see the...
Survival is important. That's
Well, he hadn't been working very well. I'm only going to give him 2 weeks severance. I'll give you 4. But I'm going to give severance to you. So I'm not going to see the effect of that until March if I let go of you in January 1. If I decide to sell inventory cheap, can I just say, here, buy it cheap? I'm going to have to go out and tell folks, hey, I got the special deal in inventory. I'm going to have to come up with some sort of a marketing program to go sell it and sell it cheap. Whatever action I take, it's going to take me 30, 60, 90 days to implement that action and see the benefit of it. If I haven't forecasted out, this guy may already be late, but if I haven't forecasted out and I don't make that decision today, thinking about I need to stay in business, then I clearly will not stay in business.
The 50,000 up there in March, is that like a line of credit?
Yeah, he is planning to borrow 50,000 and buy, I'm a little bit in arrears here, and buy $75,000 worth of equipment.
It wasn't to cover his loss.
No. No. He's borrowing 50,000. I'm glad you pointed that out. Borrowing 50,000, he plans on spending 75. If he doesn't do something else to generate cash, that's a pretty stupid decision. Okay, I'm going to buy equipment to put myself out of business. But I'll tell you what.
If you go back, well, that's a slide I was. If you go back to February, and he's in January, does he have some kind of business that seasonally dies in February? Is that how you get that big drop?
And in reality, no, I just made the numbers up. But yeah, there are businesses like that. There are
They
businesses,
all fall like hell at Christmas time, you bet.
they fall out, a lot of them fall after.
Right after.
If you're a retailer, anybody do retail kind of things? You're sort of in retail. The average retailer, over 40% of your business happens between Thanksgiving and Christmas. So now, if you have a receivables based on that, there are companies that see that benefit in January because people start paying their bills. So they may see it in January. But there's no rhyme or reason to this company, but there are businesses that are highly cyclical. Went through something with a client today, and they're looking like, the slope of the business looks like this. And the guy's telling me he's not going to hit his year-end target. What?
Can I ask a question?
It turns out it's seasonal. He does that every year, and a month from now it turns the other way, and there's reasons for that.
In February, the materials paid $33,000. Is that a consistent something he knows he's paying every month? Or is that just something he chose to do? That's a good question.
He chose that. He's got a production line. He's running it straight out every month, same.
Okay.
I'm building the same amount every month
Okay.
because I got whatever number of people are in this company that cost me $13,000 a month. I'm doing it every month the same.
It just doesn't seem very logical, but that's
Well, it probably isn't. He's not planning around his finances. He's just planning. I tell you what, you get into a factory, people that are building things, they like to do it consistently, the same way, the same amount all the time. The last thing you do when you build something is you want to have any kind of variations at all because it's painful and it makes you work overtime. The managers that don't get paid for overtime, it makes them have to do that kind of thing, and they all want to run a level load, consistent thing. And they go nuts when you say, nope, my financials won't let us do that. We got to build a little bit more this month, a little bit less next month. This is a guy that apparently believes the best way to run his business is just to keep doing the same thing over and over again. A whole bunch of things you could look at on this. But in your business, go do that forecast and start analyzing those kinds of things. Now you got to, all of a sudden now things are not quite as good. I got a downside on this, and I may not have the revenue I thought I was going to have come March and April. Now what do? I've looked at this and I said, yeah, I've got, what's the number in March? I was going to do 90,000 and 100,000, but there's two big orders that bring that in. So if I don't get those two big orders, what happens to my business? I'm done. It's all over. Is it? I've got some time to work it. In this case, I got $8,000, so I got about 2 months to fix this problem. All the things we talked about are the same things we could look at. Why am I building inventory? Can I sell what inventory I have cheap? Can I cut all my expenses? Do I tell, hey, all you managers, sorry, you're taking a 15% pay cut for the next 3 months. You have time to make the decisions. But if you're not forecasting it out and looking at the upside and the downside, you won't see it coming. And all of a sudden you'll turn around and the train will run you over. Do the forecast. How many people know what the break-even is for their business? How many hunks of chocolate do you need to sell? How many log cabins do you need to sell a year just to break even? Just so you don't lose money. How many people have to come hit a bucket of balls? You probably measure it in bucket of balls.
That's exactly what it is.
So he's got it. The break even is the amount of business you have to have just to not lose money. And it's an important thing to know. Because if you don't know what that number is and you're just going about it, you may end up one day not being at that break even point and not making the money. You can express it in units, where it's the fixed expenses of the business divided by the contribution margin of the business, or you can express it in revenue, where it's the fixed expenses of the business divided by the contribution margin of the business. Fixed expenses typically don't vary according to sales volume. If I'm taking $100,000 for me out of the business and I've called myself a fixed expense, I don't care if I sell one thing or 1,000 things, I'm going to be $100,000 that year expense to the business. That's fixed. If I have a mortgage payment on a building, typically that's going to be a fixed expense. I'm going to pay $1,000 a month. I don't care how much product goes through that building or how much service I sell. The variable expenses are directly related to the selling activity. So how many pounds of sugar? That should be a variable expense. How many boom things, or the stuff you put inside these things? That should be a variable expense. The labor input, you've got people that work for you that do the metal bending and that. That's a variable expense. They should be tied, though you may want to call them fixed, but typically those kind of people in a labor force are going to be tied directly to the product. So the contribution margin is the unit revenue minus the variable expense. And we're going to work through an example or two here. The contribution margin percentage is the contribution margin in dollars divided by the unit revenue. So the break even in units. This particular company, if you go back to the income statement, it's got fixed expenses. I want to divide them by the unit contribution margin. So the fixed expense is $400,000. And if you go back to the balance sheet, I think I threw in admin, sales, a couple other elements on there and called them the fixed expense. It was $400,000. I don't care how much I build. I've made the decision in my business that those costs are going to be there regardless, for now. The unit sales, I said, was 50. The unit cost was 28. That 28 is $20 for material, and those numbers also happen to add up to $8 of labor per unit. So between my labor building this thing and my material, it's costing me $28. So every time I sell one, I am contributing $22 to my fixed cost. So I sell it for 50. I had a variable cost of 28 going into it. I'm getting $22. So to get my break even in units, I take my fixed cost, $400,000, I divide it by the $22 of contribution from each product, and that says the break even, I need to sell 18,182 units. If I don't sell that amount of units, I don't make money. If I sell more than that, I make money. The more I go above that, the more money I make. So that's an important number to know. I have got to sell. Hey, Mr. Sales Team, you're my sales manager. You have to sell. Tough. I know it's a tough market. I know nobody has any money and everybody's blowing you off these days. You still got to sell 18,182 units. Has to happen or we have a problem.
How do you convert that to a service-based formula?
It's
Selling widgets.
Well, you're not selling widgets. How do you? I price myself, and let's just say I do it in hours. I don't price myself by hours typically, but let's just say I did. If I have to have certain cost, and I'll make it real personal. I have to worry about my business. I have to have certain things I have to pay for. I have a chamber membership and I have an EDC investment, and I have to buy some papers and stuff just to exist. I'd call those kind of things fixed. I also have to take out a certain amount of money out of my business because I got to do things like eat, pay the mortgage, and I have a household budget. I have to, out of my business, make enough to fund that household budget, and I know the minimum. I mean, when I set my business up, I mean, this is sort of how I went through it. So now I've got this fixed cost. Now that minimum happens to, I turn it into a salary for my business, that becomes a fixed expense. Now if I'm getting paid $10 an hour, I take that and I divide it by the $10 and I'll get a break even of how many hours I have to work. So let's just say all those things added up to, I'll make the numbers easy, $1,000. If that'd be nice to pay my mortgage and my food and everything else for $1,000 a year, that'd be great. But let's just say it's $1,000 and I'm making $10 an hour. If I divide 1,000 by the $10 an hour, that's, so I have to work 100 hours just to meet my basics and to survive. I think I'll get more than that business. Now, if you look at it from what's my break even in terms of a revenue, very similar. My contribution margin is $22, or for every dollar I sell, 44% of it is going to pay my fixed expenses. So I take my $400,000 of fixed expense, I divide it by the 44% contribution margin. It tells me I have to, just to break even, do $909,100 of revenue. I have to, so you got to bring me in that much revenue. Got to bring me in that much revenue. Now that happens at a $50 sales price, remarkably, happens to equal 18,182 units. So that's the minimum I have got to do. Anything less than that, I'm losing money and I'm in trouble. That's my critical survive point. So there's ways to manage to break even. Raise prices. You're shaking your head. No, sometimes you can raise prices. I've seen people raise prices in a tough economy and do well.
You take a risk of going for that many thousands of units before you could make a profit. I wouldn't, Jesus, you couldn't get me tied up in that damn thing.
Well, yeah, if I had an investment in this business, I'd be firing the owner. There's no doubt about it. This is not a really sound business, but I'm using it for an example too. But you're right, you would not want to be, yeah, he's not making any money. He's at break even now. And he's investing.
Too many things can happen in that 6 months period while you're breaking even to put you right out of business.
Absolutely. You don't want to hover at break even. That's a risky place to be. That's why you need to know where it is. You got to have the actions in place to get to break even and then get above it. One way is to raise prices, because if I can go out to the marketplace and say, man, I'm underpriced at $50, and I figured that out. All my competitors are up to 55, so I'm going to go to 54. Well, that means I still have to get $909,000 for break even. So somebody can do the math for me, but that's going to reduce my $18,000 down to something like $14,000. Your job just got a lot easier as a director of sales in the business. So you can raise prices. You can lower the variable unit cost. So if it takes you less to build it, and you sell it for the same amount, you have same amount of widgets.
Yeah, I'd figure out how to cut them costs down someplace.
Yeah, absolutely. Or you can reduce your fixed cost. Paying people too much. You got too many people. You need to look at all of those things. Those are the three things that will allow you to lower your break even, get out of the predicament you're very accurately seeing, and lower your break even. And I'll come back to that as well. Also want to look at the cash flow cycle. We've said cash is king. We have got to manage the cash flow because that's how we're going to stay in business. Now, the cash flow cycle, this is the time between when you expend cash, because you spend money before you get money back. You don't get, most customers, there's a few out there you get to pay ahead of time, but most customers, you got to perform the service, you got to buy the metal, you got to put the labor into it before they're going to pay you for it. So that time between the expenditure to make the product or deliver the service and when you collect it, that time is typically called the cash flow cycle. The shorter the time period is, the less cash you need. So, and this is going to be a business like yours, how long does it take you to design and build that house? If it's a long time, you're going to be tying cash up. The cash cycle, it's the average inventory collection period plus the average receivables processing period minus the payables period. Real simple equation, and that'll tell you what your cash cycle is, how long you're tied up. Now, this is that wonderful Survive company again. They get material in, they pay for it 30 days. They start production. It takes them about 30 days to build this $8 labor product. Then they've got it sitting in finished goods before they do anything with it for about another month. Then it takes them about a month to typically do a sale. And then they allow people to take 45 days to pay them. So they've got this long, the cash cycle starts when they start expending cash. Not the day they buy the material, the day they pay for it, until they actually get the money back in. So they've got a material cash cycle because it starts at one point and a labor cash cycle that starts at another point. So they've got about 90 days on both here. They're tied up on this $28 product. It's taken them about 90 days from the day they start laying out money until the day they collect the money. If I go through this whole thing, look how much money is tied up in what I'm doing before I get the cash back.
That's what you get into, that you wouldn't be paying the people weekly or bi-weekly.
I don't know anybody that doesn't want at least a bi-weekly check. So
I mean, one or the other, they're gonna have one or the other. Or
Well, they get paid monthly. There's a lot of companies that.
yeah, pay you monthly, but yeah,
labor on by the month, nobody does. They get paid every week or every 2 weeks.
but you're paying them. So you've got your cash in the business, but no one's paying you for their service yet. And that's why you're tied up to an enormous amount of money. You start to understand why this company has $2.8 million of inventory in your books. Maybe it isn't because they can't sell it. It just takes them too long to get to the point where they sell it and collect the money. Now, if you got that much tied up, you got to get that money. You just don't go do it And unless you're Ben Bernanke, you can't print it and make it happen on your own. So you've got to go out and you've got to get the money someplace. So what are the sources of money? You can do long-term debt to finance your business. You can do short-term debt. You can have a credit line. You can have a personal infusion. Equity from investors to go get somebody to invest in your business. Or you can look at your working capital, the things we've been talking about, the receivables, the payables. So let's just short or long-term debt. That's the way to do it. Let's just go call a bank and get a loan. Easy. Anybody know a bank that's lending anybody any money? They all do ads that say, we're lending money. Yeah, if you don't need it. I had a friend, it actually is that ludicrous. I had a friend try to extend a very small credit line with a bank. It was like, wanted to go from like 10 to 25 or $30,000, something like that. The bank sent a very nice letter back that said they'd be happy to do it. If they were to deposit, let's just say it was $20,000. If they were to deposit $20,000 cash with the bank, they would extend their credit line by $20,000.
Ballgame that he's talking about, that's a compensating balance. When you take that money out of the bank's vault, so to speak, for loans, they can't loan the money again, it's gone. So he's trying to get somebody else to bring money into the bank as a deposit, and then turn around and, so they don't hurt their...
Well, they were trying to get the same person to do it. So if I had the $20,000, I wouldn't be going to the bank for a credit line, probably. So I don't think we can call the bank. A personal infusion. You got more money to put into it yourself? I mean, most people are struggling right now. If they have more money, do you really want to put it into the business right now? Or are you already doing it? Are your personal credit cards already running hot? I mean, are they like they burn your fingers when you touch them? How about equity from investors? You think a bank won't give you money. You go out to an investor, they're going to want you to demonstrate that you can give them a return. They're going to be relentless with that. You've lived in that world, especially if you go get like angel venture capital money, those ugly words. I mean, they're going to be on you like, flies. And they're going to ask for something. They're not just going to give it to you so you give them 5% back later on. I'm helping a guy raise money now, and one of the things we're scared to death over is the fact that the phone's going to start ringing every night at 10 o'clock saying, all right, where are you? Where's my return? Those kind of things, or they may want a share of your company. Working capital. That's a place where you have some control. Maybe you can do something about your business and actually raise some money. Sources of cash. Shorten your conversion cycle. If you're this company and you've got cash tied up for 90 days, turn that 90 days into 80 days or 60 days or 50 days or 10 days. Do what Dell did. They had no cash cycle, almost zero.
That gets into factoring money.
No, it does not get into factoring. I'll give you another example. A company I was running, we had a couple of vendors that would put product in our factory. We didn't call it, they owned it until we put it in a product. And then we had a payable with them that was so long out in time that we would ship the finished good and get paid from our customer before we had to pay that vendor. And that was about 30% of our material cost. We had a negative cash conversion on 30% of our product cost. No factoring involved, we just managed a situation, and there are other folks, you can do that in your business. You need to reduce that cash cycle. You won't get to that extreme a lot of times, but it's not necessarily factoring, and we'll come back to that. Yes, sir.
Could you step back and define the average inventory collection period?
Yeah, if you are, from the day you start to invest in the inventory, which means either buying material, from the day I pay for materials, or the day I start paying for labor, the collection period for that inventory is, if I start that process today and I pay my $28, when do I get the cash back for that $28? Okay, does that make sense? So I've paid the $28 to build it, but she hasn't bought it and it paid me till whatever it was, 90 days later. Or reduce your break even. If you reduce your break even and you still sell 18,000 widgets, you're gonna make more money? Or you put, instead of 100 hours into the game, you put 500 hours into the game, and I've reduced, say, my break even to, well, I'll stay at 100 hours, but I've reduced my break even to $500. Tell my wife she's not allowed to eat anymore. Nobody, I'm on film, right? Don't quote me on that, I'll be in trouble. She ought to tell me that, right? You're going to end up making more money. So those are two things you can look at, you can manage without looking at external financing. So shorten that cash conversion cycle, shorten the inventory cycle. Why do you need so much finished goods? Why do you need any finished goods? You know, when I was a younger man, I'll give away my age, very few people went into a car dealership and bought a car off the lot. That's how we all do it now. You went in, you looked at the 4 models they had, and you said, I sort of want that model, but I want it with these 6 things. And 6 weeks later, you got the car. I'm looking for who understands that to see who's older than me in the room. So, or remembers their parents telling them that story. So maybe you don't need any finished goods in your business. Maybe you think you do, but you don't. Do your sales really depend on having a lot of inventory? There are folks who say, well, I don't have the inventory, I'll never sell it. Is that a true story? Are you sure? Or it may not be a finished good inventory, it may be a raw stock. How long does it take you to get that stock? Maybe you don't need to have it sitting there. Maybe your vendor, maybe the materials guys can have it sitting there for you. Cut a deal with them. If inventory is needed to produce sales, did you adjust as sales declined? I need this much inventory to produce this much sales. Now my sales are down. Did you adjust your inventory? Or are you praying that sales will come back? Only praying, not necessarily doing anything. Is there any part of your inventory that's not as valuable as other parts of it? The example I gave of a customer, a client of mine, having a whole bunch of inventory that had no value. Does that situation exist with you? Can you sell the older inventory for less to get the cash? This Survive company, why should it take you 60 days to produce a product? Are you kidding? $28 product? $8 of labor and it takes them 60 days? How long does it take you, you don't have to answer, how long does it take you to make one of these things? Why does it take you 60 days? Can't you get it done in 30 and reduce the time that material is tied up? Why do you need the raw material sitting there? I don't know how you make booms, but you probably have that corky stuff that you put into cloth. So how much cloth and corky stuff, you can say how much I know about your industry, how much of that is sitting around? Or can you make the finished product after the fact? Can you work with the suppliers to have them take on some of the pain? Think about this. Your business is struggling. How about the supplier's business? You think they're having a rosy time this right now? No. So can you cut a deal with them that says, I tell you what, I'll give you a little bit more of my business. I do business with both of you, but I'll negotiate with both of you. I'll give you 70% of my business if you'll hold inventory for me. And I'll ask you both, and one of you will say maybe yes, and one will say no. So I give you more business. You hold a little inventory. I'm not losing on, I'm still getting, you both have the same price, same quality. It's not hurting me a bit. It's helping me because somebody else is holding on to my inventory for me a while. The company I mentioned actually had a store in our plant. They were trying to grow like crazy, and they had all kinds of cash. They just had a lot of money. So it was worth to them to hold inventory for people. And they only did it with really credit-worthy kinds of folks, so they ultimately got paid. It was worth it to them to hold the inventory. See if you can do something like that. Focus on the cash aspect of your inventory. Not necessarily the sales thing and the product mix and all that, but what's the cash implication of how you manage your inventory? Receivables. Don't be so nice. Collect it. It's your money. It's your money. Why are they holding on to it for 60 days? You can't do that. It's my money. I'm sorry. You said you'd pay in 30 days. You know, it's now 42 days. Where's my money? Now, you may not want to have quite that tone, but then again, I've taken a few of those calls. You may want to have that tone, or you may want to say, what's the problem you're having? Can I help you with something else? But I got to get paid. I got to get paid. All right, I can't ship to you anymore. You're cut off until I get my money. Don't be so nice where, oh, you'll send me a check, thanks. Check's in the mail, thanks. Click. If they're slow or questionable, get money up front. Get half of the money, get a third of the money. Most service businesses, like if I get a new client, it's at least 30% down. And then there's milestone payments. And I do that because I have a perishable product. Once I deliver, it's not like I can go get a product back. I'm giving a service. If you're doing a big chocolate deal, that's a physical perishable kind of a product. You may want to get some of the money up front and then have milestones that they pay you over time. If you're doing a big thing for, Who's doing, BRPH does doing, like they got a big new building down south. If you did something cool for them from an architectural standpoint, probably big, probably a lot of money involved, have them pay you progress billings. When you buy the material, they pay you for that, plus 5% profit. And then you have them hold back a little bit, but work with them to get it done. Offer discounts for early payment. You pay me in 30 days, that's great, but I need more money, so I'll tell you what, if you pay me in 10, I'll give you 2% off. And if that's what, now I lose a little money in the long run, but if I'm that Survive company and I'm dying for cash, that's probably a good thing. Look at a credit card, absorb the fees. You can factor, but I've got to tell you, factoring is the last resort because that is an expensive way to finance your business. Factor says, I can't manage my own receivables, so I'm going to sell them to a factoring company. They're going to give me back, for every dollar, they're going to give me back 85, maybe 90 cents if I'm lucky on that. And I haven't talked to a rate thing yet, but they're expensive. And then they go collect the receivable and they take the risk. Sometimes they take the risk. You can do that, but I tell you, there's a lot of things you ought to go through before you sell your receivables. Have an aggressive collection may impact sales. If you get too aggressive, if you get the tone I used with these two guys that weren't paying, then you could lose sales on that. So you want to be careful. You want to know when to be sweet, when to not be sweet. Don't put your type A personality, person who knows nothing about sales or cares, on the phone to do it. Manage it, but you can get collections sooner. Again, focus on getting the cash. Payables, stretch them. Maybe you're paying too soon. Again, hey, I told you I'd pay in 30 days. I should honor that, right? But if I'm about ready to go out of business, maybe I call you up and say, can I have till 35? Do it in an honorable way, but maybe you stretch them. Say, I'll tell you what, I'll pay you, but I'm going to give you my next order or whatever it would be. I'm just going to pay slower. Think about that. If that's what it takes to survive, if you pay early, get a discount. I know companies out there, and it drives me nuts. They think it's a good thing to allow everybody to pay them 15 days late and give them 45-day terms, essentially on a 30-day, reality 45 days, but they will never exceed 30 days. And they're hurting for cash, and they say, what do you think I ought to do? Well, one, you ought to collect earlier. Two, some of the people that really depend on you will probably help you a little bit in a tough time. I can tell you, I've called, as running a company, there were times I would call major vendors and say, I have a cash issue right now. I give you a lot of business. Can you give me 10 more days? 99.9 times out of 100, the relationship was such that they'd say, Bill, no problem, because you had already developed the relationship. And it wasn't like you called somebody you never talked to. These are guys you already, because they were important to you and there was real cash involved, you got ready for that. Reduce your purchases. One way you keep payables down is don't buy things. Don't buy as much inventory. When you go to Home Depot for your office supplies, don't stock up for a year at a time. You're probably not going to save a whole bunch of money. Again, focus on the cash aspects. Lower your break even. I was at a lunch with a couple of lawyers about 6 months ago, and we were talking about small businesses and the problems going on, and someone says, I know the key to running a small business. And I said, what? And then I said, I'll tell you what I think. And we said simultaneously, she said, maintain a low overhead. And at the exact same time, I said, run a variable cost business. And then we laughed and said, we said exact opposite things that are exactly the same. If you're a small business, always, you said it before, don't have so much overhead. If you can run your business with really low to no overhead, that is a good thing. And especially when you're a small business where you're personally dependent. It's not like Northrop Grumman's going to give you a paycheck. You're dependent on what's coming out of it. Get rid of the overhead, because then you don't have to worry about trimming it. And if your business, if you have zero overhead, what's your break even? Zero. Anything you make, you're going to be producing profit. Now, you're never going to get to zero, but the closer you do get to zero, the better off you are. In bad times, you got to really look at your overhead. In good times, you should still really be looking at your overhead cost, just because it is a neat thing. I had a pretty big business in West Melbourne, and we hit 2,000, if you remember the telecom slide. I'll tell you what, I was afraid to answer the phone. It was order cancellation after order cancellation. I mean, it was a dismal position to be in. We had a very low overhead business, a very high variable business. It was easy to shed the cost. Easy to shed. Overheads tougher to shed. Fixed costs are tougher to shed than the variable cost. Have a variable cost business. Don't incur any costs unless you absolutely need it to ship a product. Why do you have that other cost sitting around? Go look at your business. I guarantee you, everybody in here is spending, depending on service businesses, they're probably a little less, product guys, at least 10, maybe 15, 20, 30% is, you calling it fixed, it ought to be variable. Make it variable and make it something you can shed. Tackle overhead. Go after it. These are the kind of things you see in overhead. So reduce them all. Why are you paying so much rent? Why don't you go renegotiate it? Sublease. I got 1,000 square feet. You need some room. I'll give you 500. Sublease it. Sell and lease it. Move out. Move home and go virtual. I talked to somebody that's pretty wired into a lot of small businesses in the southern part of the county, and they said one of the reasons we have so much vacant office space is so many people are going home and working out of their home. I've had a home office now for 7 or 8 years. I have no lease costs. My wife ran a construction business. She had an office. When business went down, she has an office in the house. Her partner has an office in his house. Their cell bill went up because they talk a lot more on the phone, but they got rid of the office space. Think about that for your business, especially the service businesses. Why do you need to pay money for an office? Anybody ever come to it anyway? If you do have to have an office, you can renegotiate now. Don't think because you got a $1,000 a month lease, it's going to stay there. Call your landlord and say you want to renegotiate. I tell you, there are landlords out there. I know of one that came into a client of mine and said, I want to meet with you about your lease. Lease is not due up for 3 years. You know, what are you bothering? He says, you give me 2 extra years, I'll lower your payments 20%. Now. He did that preemptively. Go ask. This guy's got so much vacant space, he's trying to get a few people tied up for the long haul. Good time to negotiate. Utilities, phone, internet. Turn up the, quit trying to keep your place at 66 degrees. Turn it up. Cut the phone use, except for customers and making money. Cut your cells. If you have employees, most of them don't need a cell phone. Get rid of it. They're just talking to their girlfriends and boyfriends on the phone anyway. Administrative personnel. Do they produce revenue? Have you got extra people sitting around that do not produce any revenue? And if they're not producing revenue, do you really need them, or are they a nicety? When our telecom market was going down, we got rid of all admin. I'm running a $150 million company. I don't have a secretary. You know what I found out? I didn't need one. 99% of what I did, it took me more time to interface with my secretary than it took me to do things. If I went online, I'd drive somewhere, call a travel person. This is back before you had a lot of the internet booking. It took less time to book my own flights than to call my secretary, have her do it, get back to me. We found out as a business that almost all the admin we had was useless. I shouldn't say, they were nice people, they worked hard. The business didn't need them, they weren't generating revenue. Think about those kinds of things. Sales personnel, demand performance. My director of sales over here, I don't want to hear your excuses, 18,000 units a year, or we got a problem. Demand performance. You really got a problem? I'll tell you what, you get me 20,000 units and I'll give you a bonus of $15,000. How's that hit you? So demand performance, or look at ways of incentivizing them more, but go do it deliberately. Sell your company plane. Right off the top, sell your plane. Yeah, I laugh about that, but I worked in a corporate office once where I made that recommendation. I made some real enemies out of some folks. Are you overusing your cars? Are you paying mileage? And some of these are simple things, but you'd be surprised. The smaller your business, the more important they are. But in any business, they start to add up. Maintenance equipment. Do you have too much supplies? Do you over-maintain your equipment? Do you have people coming in to maintain all your equipment? Can some of it you do yourself? Since you don't have as much business as you used to have, can you spend a little time on equipment maintenance and quit paying the guy down the street? Those kinds of things. Office supplies. Do you really need colored paper? Can't you do it on a simple $2 ream of of cheap white paper? Pay your taxes. I do not recommend slowing down on taxes. That'll kill you. Some folks do it. And management costs. Anything you call a management cost, are you really making money with it? Or is it just an expense and you think it's a cool thing to be doing? Travel and living. Are you combining trips? Do you travel cheap? Do you stay in $3,000 a night hotels like the head of the IMF, or do you stay at Travel Lodge? I only say Travel Lodge because I'm staying at Travel Lodge in a few weeks, and my wife said it's so cheap she's worried about where we're staying. But we're meeting people there. Interest. When you're borrowing, know the fixed costs you'll incur. Always be negotiating. Data processing. Do you have to have it yourself in-house, or can you do it a cheaper way? Training. Can you delay training? I sat and overheard a conversation of a very large client of mine today. It was a senior guy complaining to a more senior guy about the lack of training. And it was going through, we have the ability to do that ourselves before we're going to go pay for it. That was the gist of it. This is a company which spends a lot of training dollars. And they were saying, we're going to bring a lot of it in-house because you know it better than the trainer we're hiring anyway. You have free time because the business is down, or even if you don't make free time, you do the training. And they were going to be saving significant dollars. Dues and subscription, go to the library, go online, quit paying for some of that cool stuff. Legal and accounting. Do you need the same level of accounting and legal support now that you had when you were twice as big? Probably not. Benefits, can you trim them till business gets better? State just cut state pensions 3% in the latest budget. They had to do it. Have you done that with your business yet? I remember that one because I talked to a couple of state employees last night that were very unhappy. And I sort of said, think of yourself as a business. You've got to survive first as well. These decisions are often very difficult. I'm making light of some of them, but they're extremely difficult. They can be very painful, but what's the alternative? If you're this business, survive, and you're about ready to go under, you've got to make some of these difficult decisions or you don't survive. So would you rather make a difficult decision and implement it or be out of business? What happens if you go, I got 20 employees, they've been with me forever, I can't let 5 of them go. All right, let's wait till March and let all 20 go. Does that help? It sounds a little cold and callous, but the reality is you're going to let 20 go, not 5. So sometimes you need to make those very, very difficult decisions. Reduce your variable expense. Material cost. Can you negotiate? When's the last time you went back to your vendors and said, I want to pay you less? I don't think that'll work with the sugar vendors in today's market, but anywhere else you probably ought to try it. Compete your buys. When's the last time you competed? You've been dealing with the same vendor forever. When's the last time you went to the other guy or 2 other guys and said, can you do better? Everybody's looking for business. Everybody. I don't know any businesses that are, any markets that are screaming right now. So they're all hungry. Go force the competition on your vendor base. Packaging. Is it really important, or is it just a nice thing? Can you lower the cost there? Labor. Use temporaries. Reduce staff. Cut efficiency. Sorry, guys, everybody's taking a 10% pay cut. I know it hurts, but we got to stay in business. Would you like to have a job or not? I met with a company not long ago, just a few weeks ago. They just basically took, for anybody they could legally do it, they took a 10% pay cut across the board. Sat down with everybody and explained what was going on. And they went through all the other things they were doing. And everybody sort of said, don't like it, but it's the right decision. So you may need to do those kinds of things as well. Using temporary or just getting rid of staff. Sometimes having temporary workers as opposed to having full-time employees not only can save you a little money at times, but it is an easier part of your workforce to trim when you need to trim it. So if you have an employee who's been around for a while, sometimes the laws, sometimes severance things, company history will take it longer to shed the cost. If it's a temporary worker that you're getting from some service agency, Manpower or Kelly Services or somebody, you just say, go home, you're done. Again, it sounds callous, but you've got to keep your business alive and you need to survive. A lot of these things, by the way, if times are good, you got to think ahead of time when times may not be bad and position yourself with these things. Shipping, consolidate shipments, change carriers, commissions. Maybe you take them down. She's not hitting 18,000 units. I'm not giving her a commission. But she hits 20, maybe I'll give her a bigger one. Supplies, utilities. I said I had that on the fixed column. Maybe it isn't fixed. Your utility bill, I'm going to guess, is mostly variable. You're running equipment, right? So are you watching utility as a variable cost, and can you manage it that way? All costs, this is something to remember, all costs are variable over time. We've talked about fixed, we've talked about variable. A lease, fixed cost, right? Oh, if I sublet or if I get a point where I can convert it at the end of the lease term, I can make it a variable cost. All my employees, I may say that, my son-in-law is a fixed cost. I had to bring him into the business. Not really. I could get rid of him. I don't have a son-in-law like that, so I could say that easily. Now I know who has the son-in-laws they're worrying about. You can get rid of your data processing. Well, I have to have a computer, right? Got to have a computer to run your business. Go virtual. Go rent space on somebody else's computer. And there's several companies in Brevard County that are really good at that, really good at doing that. They just say, all right, you need it, I will sell you a workstation, and you're on my computer, I'll give you all the software, and it'll cost you, I think they're like 40 or 50 bucks a month. That's a variable cost now. You don't have those employees, they're gone. You're not sitting there with the outlay of hard computer equipment and hard software licenses. Staff seems fixed, but no staff is fixed. Now, sometimes you want to look at your product costing. You're going to have to make some interesting pricing decisions in a tough time. So here's that same company. We'll go back to an annual plan. They're going to try to do a little better than last year. They're going to sell about the same, but they're going to try to make a little bit more money. They think, though, that so an opportunity would typically look like this. About 1/5 of their sales, they'd get about $200,000. It would look like that, and they'd bring $21,000 to the bottom line. And I'm expecting to get that business from you. But you walk in and you say, Bill, man, things are tough. I just can't do it. But I am willing to pay you $150,000 for the same product. Do you take the business? Who would take that business? Who wouldn't take that business? Your profit, you've got the same variable cost, because the number of units is the same, got the same fixed cost, so my profit on my income statement is going to be a minus $29,000. Got some decisions makers in here. Nobody will take the business, nobody will reject it. Anybody reject the business? Anybody that really wants it? By the way, I'm counting on her. I need that. I need her account. It's not like she's going to fill in with an order.
I don't want it, but I take it.
Why would you take it?
Just to keep things going.
Keep things going. Here's another reason to take it. If I don't take it, I'm going to spend the fixed cost anyway, right? So instead of losing $21,000, I'm going to lose $65,000. And essentially that's cash. If I don't have the ability to make it, and I have the capacity, I'm under capacity. And if I look at it from the other side, if I look at the contribution margin, I'm putting $36,000 into paying for my fixed cost. Any way you look at it, if you can't fill up that capacity with something else, then that's going to cost you more to not take the business than to take it. You need to think about those kind of elements. Break apart that variable cost and that fixed cost when you're making tough pricing decisions. Let's go back to break even. Let's reduce overhead costs by 10%. Let's reduce variable costs by 10%. Big challenges? Anybody feel challenged by taking a 10% cost and challenged and variable and fixed? That bother you? You could probably do that, right? All right. So my old fixed cost was $400,000. It's now down to $360,000. Unit sales are the same. My variable cost goes from 28 down to 25. My contribution margin goes up. So my break even now in units, fixed cost divided by my contribution margin, I only need to sell 14,400 units to break even. Or from a revenue standpoint, I only need 720,000. So by reducing my fixed cost by 10% and my variable cost by 10%, I need 21% less business to hit my break even. So if she brings in, I must have scared her with the challenge to do 20,000 units. If she brings in anywhere close to that 18 and I've lowered my break even to 14, that's a good news story, isn't it? So challenge both above the line and below the line on cost. Now, we've talked a lot about cost, managing to the numbers. You got to go sell too. It's not about, sometimes, and a lot of businesses do this. Some will be smart and do everything I've talked to up till now, and they'll really hunker down and they'll wait for something good to happen. But aren't your competitors struggling too? What if they're hunkering down? Opportunity. Maybe it's a great time to go steal their business. I go to a lot of networking functions, chamber kind of stuff, though I'd never get up this far typically. But you talk to people about their businesses and they all lie, right? How's your business going? In a chamber function, you're taught to say, yes, really good, great, and it's not. Every once in a while you find somebody who tells you that most people today are, it stinks, and done yours. I talked to this one guy and he says, my business is great. And I said, yeah, right. He said, no, I'm not kidding you. I have hired 5 people. This is going on, that's going on. I'm like, whoa, what are you doing? He said, I looked around one day feeling sorry for myself and realized that my competitors were feeling even more sorry for themselves. So I decided to go after them and take their business. And I did it. 2 of them are out of business. I have all their business. I know an accounting firm in South County that's hired 4 people in the last 6 months. All from smaller accounting firms that went out of business. And they said, we're going after the business. And they got very aggressive to go get it. Brevard County right now, retail sales today are about 20% less than they were at the peak of things, back before the crisis started. So that still says that 80% is still being bought by somebody. So your objective is to go get that 80%. I'm not going to let you have your same market share. I'm going to take it. Don't think for a minute that I'm not going to come after you and take all your business. I'm going to go get it. You know anybody in the worlds you live in that are overly aggressive in selling right now? Or are they just praying that this ends and the economy starts going up again? You deal with a lot of people. Most of them in prayer sessions, they're actually out working to get it. You know the right people then. A lot of people are just hunkering down. Pardon?
I said, that's why Jerry's here and several of our chamber members are.
Everybody, but there's the ones that aren't here, they're home doing the work because they really don't want to get out. How much selling are you doing personally? Or are you relying on the advertisements? I know a lot of business owners that, how many chamber members never come to functions? Because they don't want to sell. They've got one in the back of the room. They don't want to sell themselves. They think the ad will work, and it has worked for 5 years. But you can't afford the ad anymore. So why don't you get out and do it yourself? It's really not that hard. You're looking at a guy who is a wallflower, extraordinarily shy, but I'm in a business where nothing works but getting out in front of people and selling yourself, because you are, in fact, selling yourself. Teach yourself to do it. Trust me, you can be taught. I went through a lot to get to the point where I can go personally sell myself, but go do it. Don't wait for somebody else to make the sale. Get personally involved in it. If you have a sales team, have you incentivized them properly to go get it? Have you given them the opportunity to get as rich as you if they bring in the business? Are you making them work harder and smarter? What can you offer customers that will make them want to buy more? Why should I come buy more chocolate from you? Okay, I buy $100 of chocolate a month. What do you need to do to me to get me to buy 150? Think about that, because now you've got a customer. Can you get them just to buy more of what you do, or to buy it from you and not your competitor? Why do I want to get my fancy architectural steel stuff from you as opposed to somebody else? I want to go steal that business. Is your pricing competitive? You looked at all the trade-offs. Have you looked at that trap of whether you're pricing appropriately to get the business? When's the last time you honed your marketing plan? Everybody have a marketing plan? Not a whole lot of hands go up. Have one. Have one. When's the last time you actually honed it? Do you know who your customer is today?
Yeah.
You sure?
Yeah.
You sure?
I just got through writing a 200-page book on it.
Well, maybe you know. Do you know what they actually want? Has it changed? Is it different today than it was 3 years ago? Do they want something different? The whole customer base of the world has changed. When the economy changes, the thought processes change.
Even the banks have changed.
Everything's changed. Who are they? Who are your customers? Who makes the decision for your product? Who makes the decision? Anybody here in real estate or touch real estate? Who makes the decision to buy a home? Husband and wife go around, they look at a home, and they decide to buy one.
The wife does.
What's the decision process? I asked a group of realtors that once, who makes that decision, the husband or the wife? And it's 100% the wife. Guys, we have nothing to do with it, nothing at all. Our wives let us think we're part of the decision process. Forget it, we're not. The wife makes a decision to buy a home. Do you know that about your industry? When you sell booms, who's actually buying those? A procurement agent that calls you and says, I need 100 booms, what's the price? Or is it some technical guy sitting in the corner? Or who you're doing technical services? Who actually makes the decision? You got to go through a procurement office. But do they have anything to do about whether you're picked or not? They put you through hurdles. Or some engineer literally tied up, I know those engineers are, tied up in some back room that's going to make the decision. Do you know who that is? A lot of times, the decision maker, your actual customer, may not be the person you even see. So think through about who they are and where are they. Where are they? You sell all over the country. Where are most of your customers? Do you want to be selling log homes in downtown Manhattan? Probably not a big market for them, but do you go in a magazine with your ads that might be there? Think about where they are physically, where they are in their cycle. What's your competition doing to beat you? Do you guys know everything there is to know about your competition? Everything there is to know. You should know your competitor as well or better than you know your spouse. I'm not kidding you. That sounds like a flip comment, but you got to know them inside and out. You'll learn about the market, and what they're doing really, really well, you want to make sure you at least match it. What they're not doing too terribly well, you want to figure out how to do it better and make sure the world knows you do it better. Now all of a sudden, they don't beat you anywhere, you get all the business. What's your competitive edge? Why do I want to buy a log cabin from you? I picked up one of those travel magazines, and there must have been 10 log cabin companies. Yeah. And they all had pretty ads. Why you? What makes you different?
Well, number one, I got a triple tongue and groove log instead of just a saddle.
I don't even know what that is, but okay, I'll learn. You know, why do I want to come to your business? Why do I get my booms from you? You've only been in business 4 months. I doubt you could support me if I have a big problem. Why do I want to come to you? I don't know your business because you walked in late. Oh, you're with him? All right, then why do I want to buy your booms? Can you answer that question? What sets you apart from your competitor? Why do I want to? Hey, Grimaldi's is right down the road. They got a national reputation. I'm buying my chocolates at Grimaldi's. Why come to you instead? You got to know that. You've got to differentiate yourself. A couple people are in a startup mode. You're in a startup mode. You're not far from it. You're in a startup mode. Don't go spending a whole lot of money on your business unless you have a competitive edge, something that will separate you from your competitor. And the tougher the economy is, the more important it is to know what that competitive edge is. And when you're given the opportunity, like I just gave everybody in this room, to tell me your competitive edge, tell me. Come right out with it, know what it is. When you walk into a chamber meeting, give your competitive edge. Make sure something in your 30-second elevator speech is what separates you. Why do I want to even talk to you, let alone potentially buy your product or your service? Really hone that down. And in tough times, you segregate yourself. You'll get a bigger part of that 80% that's left than you would get if you can't show any differentiation. Do you have a clear message?
90% of your customers today, though, that you're looking for in many businesses don't have jobs. And that's what's hurting us all.
In some businesses, a competitive edge may be able to exploit that. Do you have a clear message? What do you want your customers to hear? Do you know what you want them to know about you? What is it, if I'm a potential customer of you, what do you want me to know? And once you figure out what you want me to know, how are you going to get that message in front of me? What's the vehicle? You're going to put it in an ad? You're going to write me a letter? You're going to come visit me in my office? You're going to hit me in a hallway, or you're going to hit me at a chamber event? How are you going to get that message to me? And not only to me, but how are you going to propagate it to all potential customers? Are you as focused and sharp as you can be? If you have not really sat back and re-looked at your marketplace and how you're going to approach it, take the time to do it. It is always critical. It is a lot less critical in 2004 and 5 when there's more business than we could handle. It's really critical now when you are trying to fight the person next door for your share of the pie. Take the time to really sit back and understand how you're going to give a competitive message through what message to the town marketplace. So are you marketing and selling, or are you just waiting for better times? You got to go get the 80%. 80% of the business is still out there. Go get it. Now let's just put all of these things together. Let's get aggressive selling. Let's just raise our sales. Let's get aggressive and go get 5% more sales. That's not very hard. We already figured out overhead and variable costs we can reduce by 10%. Not a problem. Let's extend payables 5 days. We okay calling all our vendors and say, hey, I'm sorry, I'm going to be about 5 days late. You okay with that? Probably so, right? Let's reduce our inventory by 15 days. Everybody in this room said, this guy's nuts. He's got all that inventory sitting around. Let's reduce it by 15 days. Let's reduce our receivables by 5 days. Let's just get on the phone and remind people they got to pay us. That alone will probably reduce your receivables by 5 days. So if we do that, we get aggressive selling. We're going to raise the amount we sell by about 1,000 units. We're selling 20,000, 5% of that's 1,000. That's $22,000 of contribution margin that goes straight to my bottom line. I'm going to lower my overhead, 10% of 400,000, $40,000. I'm going to lower my variable direct cost. So that's 10% of 28. 2.8 gets me down to, by 21,000 units to 20,000 original plus 1,000 new. That's $58,000. If I extend my payables, my inventory, reduce the inventory, reduce the receivable days, I'm going to reduce my cash cycles, 25 and 20 days. I'm going to free up on that same chart $1 million. $1 million I'm going to free up on that chart. But those small things that we're doing. So now I have freed up. I can either spend it or invest it or do something with $1 million. I've lowered my break even by 20%. I've increased my profitability by $120,000 on this $1 million business. And I am, I can sleep now. That's really important. I have survived and I'm positioned to go take on the competitor, maybe go steal the market, and certainly be ready when this thing starts to turn up again. So manage to your numbers. Make sure you understand the financial ramifications of all your decisions. Get the business that is out there. There is business to be had. Stay focused. Whatever you do, stay positive. Go to work and survive. In fact, don't just survive. Make sure you thrive. I'm going to turn this over to my legal friend back here unless anybody has any questions. Good. I look forward to you guys being successful.